You have indeed joined Entrepreneurs Unity Group, where you will get inspiring information to help you grow and be positive. Welcome. If you have not yet clicked on the subscribe button to receive notifications in due course. Art content specially designed for your personal development. You have certainly heard about the stock market, where companies and businesses trade their shares and investment values. Investment opportunities are everywhere, only for those who know how to exploit them, discover them, and take advantage of them at a time when working smart is the best way to win. Stock trading is very profitable. Ownership and holding of securities too, interest and dividends on shares. As you might expect, not everyone is involved in the literal buying and selling of stocks. You will see more details in this video.
Consider a hypothetical firm, Harry & Harry, that just achieved $5 million in sales at the conclusion of a business year. Their return on sales is only $1 million. Seeing that their business prospects are good and that they can earn more money if they grow, Harry & Harry put out shares to sell. They decide to sell 1,000 shares for $1,000 apiece. So Harry & Harry assign $100 profit to each share. The profit is known as earnings per share. And purchasing 5 shares would imply that you're purchasing $5,500 of the company's profit or loss. The main profit is the rise in the company's stock price, which happens over time. That's why the stock market should be considered a long-term investment. And Shaber was a woman who earned less than $4,000 per year.
If you decide to invest in common stocks for the long term, what you should do is buy a company stock and wait for it to yield in time dividends. Periodic profits can be made, and you can finally sell your shares to someone eager to purchase. To create profits that matter, you must monitor business news about firms that are performing well in the market and have good prospects. Since history, research how their stock has grown over time with a focus on the recent 5 years in particular. Choose a firm with great leadership and policies. 3. Study the company's operations and their service to shareholders. You may read evaluations online, especially for well-managed organizations. The value of your stock will rise over time, and you can retain it for at least 5 years before deciding whether to sell or hold on. How stock works.
You can also decide what you want to do with your finances, but this is dependent on the alternatives provided by the firms. Other than these, you may sell your share to someone else for more than the company is currently worth. This is possible if the person sees a more promising future for the company than what it is currently worth. If you need emergency funds, you can trade part of your stock for a financial way out. So how do you ensure financial success while trading for stock? The first thing is to do your homework. Just like every business requires research, every investment requires research. You have to make inquiries, run your research, and confirm what's going on with the company, as previously suggested. But you should also do a study about the business. Invest only in businesses that you know about. Conduct market research on the industry you'd like to invest in. Trading in a market you understand will help you make informed decisions based on market trends. Invest with restraint.
But she took advantage of the stock market by buying stock. With her $5,000 savings, she grew her asset into a multi-million-dollar fortune that appreciated even onto her death. The corporation can deliver cash dividends to you from portion of their gross profit based on your agreement. Dividends would be sent by check or straight to your personal account or brokerage account. Nevertheless, there are other ways that may fetch you money. When a company repurchases its shares in an open market, it is to bring all of the shares back home, which also means the company is wealthy enough to reduce debt and internalize its profit. In addition, the company can reinvest the funds obtained from stock trading to purchase more assets for the company. What you have control over in the stock market is the amount you invest and what you invest it in.
Contrary to popular belief, stock market traders do not have to sit in front of computers all day thinking and monitoring the prices of stock commodities. Investing in the stock market can be lucrative. Easier to understand, the best way to make money in the stock market is not necessarily to constantly buy and sell bonds. The secret is to buy the security and hold on to it. This is the classic Warren Buffett investment style. Buying or investing in stock means you're buying a share of the company. Owning a specific share in a company means you've contributed to their working capital and they would make trades with your money. You're entitled to an equivalent amount of profit by percentage as your periodic share. Additionally, as the price of the stock rises, your value with them rises. That is, the monetary equivalence of your share rises to a new amount. If you decide to invest in common stocks for the long term, what you should do is buy a company stock.
Yes. I'll reiterate. If you really are unsure, you should proceed with caution and patience. About the future of the company you want to invest in. You can invest by allocating a certain amount and later increasing your investment if you believe the company can do even better. Patience and a disciplined approach to investment will help you minimize the risk of loss and maximize profit. Also, make sure you invest what you can afford. Your surplus. Do not accumulate bad debt by getting your head in the game with the hope of a quick market turnaround with borrow. If things go wrong, debt is inescapable. Monitoring is essential, though the type of stock investment you make will determine whether you should worry about frequent or periodic monitoring. Either way, stock supervision is essential. Monitoring would mean keeping up with news updates, events about the company and industry you invest in, as well as stock market and stock price trends.
Be realistic. There is a fine line between investing blindly and investing based on research. Calculated danger. Working with calculated risk implies that the possibilities have been seen and appear credible to a large extent. Yet, investing unreasonably means investing with assumptions and hopes. Allow your assumptions to be realistic. Taking actual statistics into account. Become extremely wealthy through the stock market. If you want to become extremely wealthy in the stock market in a short period of time, there are a few things you should consider. The advice listed below should be followed, but you should be aware that you are not required to do so. Put in as much money as possible. This is risky, but it is also the fastest way to get rich. Putting all of your money into the market allows you to accumulate as much wealth profit as possible based on your potential. The earlier you invest most of your money into the market, the faster your financial growth will be.
If the turbulent market has a fast upward pull, the continually low market value for your investment stock might also raise profit in a very short yield period. Invest in non-dividend paying corporations. Offering dividends is a fantastic method for the firm to show appreciation for your support by providing you a portion of the profit while still enabling you to maintain your stake with them. Nevertheless, distributing dividends is a negative idea if you want to get rich quickly. They are not optimizing profits by reinvesting them in the firm. You need a company that reinvests its profits in order to create as much profit as possible in the shortest amount of time. This will allow you to cash out your shares promptly and with a smile on your face. The final line is that, as appealing as dividends may seem, they do not promote rapid wealth recovery from the stock market. Diversification is a safe approach to invest, which implies investing in a variety of firms.
This is not good for someone who wants to get super rich as quickly as possible, because you want to invest in a company with the highest prospects so that the rise in market value will take you as high as possible. That is why you have to look at the opportunities available for the company and the market values of its product when you are looking. Ensure that the product can perform properly and promptly put all of your money into the firm and watch your money increase to double, quadruple, and even more in a short period of time. Diversification slows growth while reducing risk. A low risk is a long way to get rich quickly. Invest in small or medium cap firms with potential. Small companies with potential may expand their market shares and values quicker than large companies. These companies have a good chance of winning customers' hearts, and despite starting small and working hard, success is very likely only a matter of time. For big companies, they've surpassed the rate of geometric growth. Growth is slower than it was some years ago. Picture this scenario: a company, Harry & Harry, sells in 27 states out of a country that has 30. Their products are household products, and most people in their customer demographics already use them. All Harry & Harry needs to cover is 3 more states for growth and to retain their customers. Another company, Porter Inc., manufactures a household product that is a unique solution from what the market has always known. Within 6 months of being in the market, Porter Inc. has already reached 4 states, and orders are increasing, indicating that Porter Inc. has already reached 4 states, and the orders are climbing. That means Porter Inc. has a stunning potential for growth.
To invest in for a quick turnaround, it should be Porter Inc. because it has more ground to cover and the growth is imminent. Making quick cash from the stock market is a great deal. The higher the risk, the merrier the fun. So there you have it. Like this video, share your thoughts with it, said have a good one, and I'll see you all in the next one.